The cut in the cash rate from 3.25% to 3% was well anticipated by the market and also well anticipated by us. Our take from what the Reserve Bank has announced today is that they will bring forward their rate cuts and also the extent of the rate cuts will be increased. So they will likely bring forward rate cuts of 0.25% to October and another 0.25% in November. To bring the cash rate down to 2.5% by the end of this year. The bond and cash team have been expecting interest rates, certainly short-term interest rates, to fall in New Zealand for quite some time. We were just unsure about how far and how fast they would fall. So we have been positioning our portfolios for some time in the expectation that the Reserve Bank would be cutting rates. So this announcement today was a confirmation of what we have been thinking for the last 3 to 6 months. So we've been positioning the portfolios longer in duration, locking into higher levels of interest rates on the expectation that they won't be available forever. And we have seen a reaction in markets today. We have seen 2-year, 3-year, maybe up to 5-year interest rates coming down about 15 to 16 basis points, and even a larger movement in perhaps the very short-term interest rates. So that's worked in our favour, and we were actually on the day quite active buyers early in the morning, so that was quite beneficial. I think the Reserve Bank has come from a time period whereby they have been a little bit shell-shocked because inflation got so high. And they've spent 2 or 3 years getting inflation under control, and they have been very reticent to have interest rates being cut quickly, perhaps as quickly as a slow economy may have dictated, because they've been fearful for inflation to rear its ugly head again. But now I think that the weakness in the economy, the weakness in the labour market are all interlinked with inflation and consumer demand, and I think the Reserve Bank now is far less concerned about inflation rearing its head than they once were. I would say today's announcement would put downward pressure on mortgage rates. Mortgage rates were probably going to be edging down a little bit because banks make money by lending money, and nobody has been wanting to borrow money because the housing market has been quite slow. I think with interest rates in the wholesale market now coming down, that will put pressure on fixed-term mortgages to come down, not that much, but maybe down to kind of 4.5-ish, which I believe will stimulate more activity in the housing market. But importantly, I think that it's not necessarily just the level of interest rates, it's that they're going to stay low for an extended period. And I believe that that period whereby interest rates will be low and mortgage rates don't move up, and people have confidence that they're not going to be moving up in a big hurry, will encourage more investment, both by industry and by people considering stepping into the housing market.